right, welcome everyone. Thanks for tuning in wherever you may be listening from across the Aloha State. We got another episode of the Wire Retirement Show here. Going to talk reverse mortgages. Super excited for that. But first, Paul, how's it going? How you doing?
Yeah, great start to this week. Super excited for this episode as well. A good friend and someone that I look up to for sure. Wendy Oshiro is with us. So before we bring her on, a little bit about her. So Wendy is a reverse mortgage specialist with Mutual of Omaha Reverse Mortgages. She's been in the industry for over 16 years, helping many people. She has a great team here locally, and we just love to learn more about reverse mortgages, share that with you guys, the listeners. So Wendy, please introduce yourself, share a little bit about, who you are, your background, whatever you feel comfortable with sharing. But yeah, Wendy, go ahead.
All right. Thank you so much for having me. I'm really excited to share about what I do and the opportunity that I can present to people who might have conceptions about reverse mortgages, not understand it. But yeah, before we get into that, a little bit about myself. I'm born and raised on Oahu. I love Hawaii. It's my home. And I feel just very blessed to be a part of this community. And I enjoy being out and about, serving, volunteering. I especially have a passion for nonprofits. And I think that stems from when I was a teacher. For 16 years, I was a teacher. I taught at Mililani High School as well as Hawaii Baptist Academy. But I was in a classroom for most of the day. And sometimes I used to wonder, what's going out in the real world. I used to just really want to explore my community, but it was a little bit difficult having long hours. And I loved it. I love teaching students. I love teaching math and problem solving. But after my parents had strokes 1 year apart from each other in 2005 and 2006, I was in no position to teach. I was so zapped from caregiving, from taking care of their affairs. And I actually left the school at the end of 2006. Not that I was at my parents' house taking care of them. I was actually trying to figure out medical decisions, like does my mom get surgery to clot the bleeding for her aneurysm, or does, what do I do with my parents' care? Do they stay at home? Do I bring home in-home care, or do they stay in the facility where my dad's really not very happy? There's a lot of pressure to make decisions for my parents. And so I ended up quitting my job at school, and I didn't have work for a while, actually, and which was good because I needed the time to just kind of, pray and get myself back together because I was so stressed out. And but right before then, sorry, you can stop me anytime. This kind of leads into how I got into reverse mortgages. But being at Hawaii Baptist Academy, you're allowed to share a lot about yourself, about the day-to-day, about things that I guess we want to share with kids so that they learn about what faith means. And so for me, I share a lot about my family and things that are going on. And so, of course, when my parents got sick, it was something I was totally immersed in, and I shared it with my kids and to even ask them for prayer and stuff. But one of my kids, my students, I should say, asked his mom to talk to me, to help me. And she actually because he knew that she had a solution, right? And it was about reverse mortgages. She brought her friend over to the house one day to talk to me about it. And when I found out that it was about reverse mortgages, I kind of blew up because I thought it was a scam. How dare you bring, she brought a specialist into the house to talk to me about it. I was so offended. And I just went like this. I said, we're not talking about this. And I sent them away. And then it was after I quit my job that I had that period of time where I wasn't, just kind of resting and recouping. And I also was researching because my parents still needed care. They still needed decisions to be made. And I, at that time, I found out about reverse mortgages. So, I'm a math teacher. So I didn't understand how you could have a mortgage that you didn't pay, and pay monthly. And so I made spreadsheets to kind of figure out, how is this working? Like, how do they make money? Like, how can this kind of a product exist? And then when I calculated everything, I understood it. It was too late, because I sold my parents' house the month after I quit my job.
Oh, wow.
So the kind of cool thing was, my student who introduced me to his mom, and of course the reverse mortgage specialist, he came to my house and brought cookies to see how I was doing. And then I told him how bad I felt that I had not, as a math teacher, did the problem solving thing that I teach my kids, which was, you understand your problem, you look at the options that are available to you to solve it, and then you pick the one that makes the most sense to you. And I didn't look at my options. I didn't look at them like I teach my kids to do. So it was a little bit embarrassing for me. And so I told him all of that, and then he went back to his mom, and then she convinced the friend to hire me as a reverse mortgage specialist, because of my experience, not in getting one, but in the opportunity missed to not even learn about it, So
very cool. That's a very cool story of how you happened to enter the reverse mortgage business.
Yep.
Yes. And so that makes me pretty passionate about it. Like, I really think I'm happy when people decide not to do it too, if it's informed. If the decision is informed, they have all the information, and they know, you know what, this is not really suitable for our situation, we're not going to do it. Great. Then I did my job, right? And they made the decision the right way.
Yeah.
So thank you for having me on. I'm really excited to share more.
Yeah, absolutely. I feel like even for us and many of our listeners, this might be the first time they're, kind of getting a deeper dive or a better understanding of reverse mortgages. And, hopefully just, whether it's something, a solution for them or their family or even their parents or not. I just love that you do have that passion to share and to teach, right? So, just thinking about that, let's, we'll jump in here. Kind of just, high level, kind of like Jason was saying before we push record, 101 class, right? What is a reverse mortgage? Like, what would that look like? Just so, in basic terms.
It's a loan. So it allows a senior, and it could be, the ages vary depending on the type of reverse mortgage, but most people get the FHA insured home equity conversion mortgage. So, or HECM for short. And that one, you got to be at least 62 years old. So it's designed for older homeowners to be able to tap into their equity for any purpose that they wish. And it's especially useful for people that are on a fixed income, to be able to tap into the equity while they still have full ownership of the house and full use of the home. So that's something that a lot of people don't realize, that you're not giving up ownership. You still have ownership, but it's kind of like you can't live in your 401k, but you can live in your house and still utilize the equity.
Yeah, that's good. I mean, I think, a lot of people, and especially in Hawaii, we might go here in the conversation, but a lot of it is, a lot of people are home rich in a sense, whereas, they don't have a lot of assets outside of that in some cases. So yeah, that's such a good point to be able to say, like, you still own your house, but you have the ability to access some of that equity. So that's really good. So in a sense, like, maybe go a little bit deeper, I guess, just to kind of understand that a little bit more. Like, so like, they have to own their home. So can they have a mortgage on the house already? What does that look like? Or, do they have to make payments still, or what does that look like in traditional sense?
Okay. Let's look at the name first, reverse mortgage versus a traditional mortgage or forward mortgage. So when you have a regular mortgage, of course, the bank or the lender gives you money, and then every month you have to make payments back when they're due. Otherwise, you could get foreclosed on, right? Because you're you're not following your agreement with the financial institution, and they want you to agree to several things like making the payments, paying your property taxes and homeowners insurance, taking care of their collateral, which is your house, and so on. So the reverse mortgage does have some of the same things, like you have to pay your property taxes and homeowners insurance. That's their responsibility. And the lender does give you money to use, but the difference is that on a reverse, the lender is deferring payments until a time where the borrower permanently leaves the home or they pass away. So it's a cash flow product. If you're not having to make payments to a lender for money that they're giving to you, then that's money that you can use for other things. So I always tell people, if you're looking for a way to improve your cash flow in retirement, then consider, and you're a homeowner, then consider the reverse mortgage. The number one reason, which is what you just mentioned, Paul, why people get a reverse mortgage is actually to pay off an existing mortgage balance, right? So it can free up, like, let's just say, somebody's making $2,000 a month in mortgage payments, and then they refinance it into a reverse. Now those payments are deferred until, like how I mentioned earlier. So every month now they have $2,000 that would normally go to the lender, but it's still in their bank account. Gotcha. And that can be something that just gives retirees, especially those on a fixed income, so much financial freedom, right? So much relief. So that's the main reason why people do get a reverse. But there are other reasons as well.
Yeah, that's awesome. Jason, any thoughts on that? I want to go in deeper into those thoughts?
No, I think that's a good way to start it off. Maybe we'll jump into the different types of reverse mortgages. And so for a traditional or forward mortgage, you got your 15-year, 30-year, and then there's a whole wide range of different lenders. And I don't know if you just want to give us an overview of, like, is there all the different flavors and colors that the reverse mortgages come in?
Okay, so let's go back to the traditional or forward mortgages. For many people, they're making a payment on a regular basis. And many love the 30-year fixed rate mortgage flavor, right? I guess it's a common product that a lot of people use to either refinance their home or to purchase a home. And so it's a fixed rate. And the reason why a fixed rate is very good for a lot of people is because they know exactly how much they have to pay in principal and interest every month. On the reverse side, it's reverse. So people actually like the adjustable rate reverse mortgage better than a fixed rate. And the reason, there's a lot of different reasons. I guess the main one is that there's so much more flexibility in how the borrower can receive their funds. So they can choose a line of credit. And I think if your listeners don't know, your viewers don't know, the most home equity lines of credit are adjustable rate products, right? So you have a bunch of money that you can draw out whenever you need it, but the rate is adjustable. Like, now some banks have like the teaser fixed rates for a short period of time, but if you kept the loan for its full term, then you're going to see the rates go up and down at some point. And that's scary because you don't know how much you're going to pay every month on a traditional mortgage. But on the reverse, having that adjustable rate also gives you the ability to have a line of credit. And the line of credit is a really cool feature of the HECM, I should say, the HECM reverse mortgage. I'll go into that later. But it also allows you to have monthly payments made automatically to you on a monthly basis. Or maybe if you need a lump sum, say you need, $20,000 to do some home repairs, then you can request that too, and then go back, relieve the rest in a line of credit. Or let's say you needed that $20,000 and you need $500 a month too, and you want the remainder in a line of credit, you can do all three. So provided that you have enough funds available to move around like that.
Yeah.
But, as you can see, the reverse mortgage has a lot of flexibility. And let's say a borrower chooses the line, they can have that line until they permanently leave the house. So even if they live to 110 years old, if the line is funded, they can still access the money from there. Whereas with the traditional line of credit product from the bank, you have like a 10-year draw period, right? Unless you refinance into another, line of credit. So that's why people love the adjustable rate. And I rarely do any fixed, rarely. I don't even know what the last time I did one. It's all adjustable.
Wow, that's really interesting. And, so for me, obviously, learning more about this, is helpful because, as you said at the top, it's like a lot of misinformation or a lot of unknowing, and kind of like you said, even when your first experience was like, no, I don't want to learn about that. Like, so I really appreciate you just like breaking it down, making it plain and simple for us to understand. So just, curious, who would be eligible to qualify, or what would be some of the qualifications that need to be met to even start the process? Like, is there an age? Is there a level of equity requirement, or does the home have to be a certain value? What are some of those things?
So a borrower on a HECM, let's just focus on the HECM because that's like almost all of our borrowers are HECM borrowers. That's the government insured reverse mortgage, FHA insured. So you have to be at least 62 years old at the time that the loan is closed or when you make the loan. And as far as property types, single family is usually the least complicated. If you have a condominium, then condo approvals are required. So sometimes it takes a lot of work. It could take even up to a year for the process, but most people that we help, I think, have single family homes. And then as far as equity goes, rates go up and down, and so does the principal limit or the loan amount on a reverse mortgage. So my advice to anybody listening is, if you're interested, contact a reverse mortgage specialist or someone like me, and we can actually run numbers for you to see what the current principal limits would be in your scenario. Yeah, because they change it, and it's better to track what the current situation is when you're ready to go. Yeah.
So it's not the type of thing where you need to maintain 20% or 25, 30% of equity within your home. Like, as far as like, you can borrow up to let's say 80% in the reverse mortgage. Like, there's no definitive percentages for equity.
So we have this, and you actually can look it up on HUD.gov. There's this principal limit factor table. It's a very long spreadsheet. It goes by ages and it goes by interest rates. So I think we have it all the way from, like, I don't know, maybe 1% all the way to, I think the highest I saw was maybe 12 or 13%. And then it has all the ages and then all of the percentages. So it's a very complex type of calculation. So it's really hard to say how much equity you have to have in the home. At one point we were saying 50% on average, just to throw out a number. And now I wouldn't even say that because the rates are high, so it's just good to check. But the reverse mortgage, what it's going to do is it's going to give you a portion of the equity in your home. So, and the idea is, if you're younger, you have a longer life ahead of you. So if we're not collecting mortgage payments every month, then we're letting the loan balance accrue with interest and any of the monies that the borrower used. So there has to be space for that loan balance to grow, right? So we're keeping track. We're seeing, okay, they borrowed this much, and then, this much in interest. And then every month we're looking at, the balance, and if they're not making payments, it grows. So if they're younger, there has to be more space to grow into. And that's why we don't give as much to a 62-year-old as we would to a 90-year-old.
Right.
So if you're 90 years old, your life expectancy is shorter. So we're going to give you more of the cash because we don't need all that time to accommodate growth on the loan. So I know that was a little technical, but so the younger you are, the less money you'll receive compared to someone who's older.
Yeah.
Gotcha.
So you mentioned 90 years old as just an example. Are there like top limits? Like, oh, you're too old now. Like I know like some different products have that type of stuff. Okay, so it's pretty much 62 is the minimum, and it's any age after that.
I think the oldest I had was 102. They
Oh
did
Wow,
my
her
goodness.
mortgage
amazing.
at
Wow.
102. Yeah. Yeah.
Wow,
And the
that's
next one was 101, and she's still active. She still writes books and does book signings.
that's
Wow.
amazing.
Wow.
Wow, that's so cool. I mean, you must have tremendous stories, which maybe for a different type of podcast, but that's really, really cool. So just curious, right? So like, hey, like maybe some of the misconceptions could be like, well, if you do this, you lose the home. All, you said like, you're no longer the owner, right? Which is clearly incorrect. But like, so, what does happen when this individual or maybe this married couple, what happens if they move out or if they happen to pass away, right? So what's kind of like that process, or what does that look like with
I'm
reverse?
so glad you brought that up because I'm not sure if I emphasize that. You have to be an owner occupant, right, of the home. You have to occupy the home. So the intention is to have you stay in your home for retirement, to fund your retirement in your home. So uh, so if say a borrower decides to move, yeah, they can move even if they have a reverse mortgage. They say they sold the house, then the escrow company will, of course, take in the payment from the buyer, and then we'll apply it to pay off the mortgage, and then the rest of the after everybody is all paid off from the transaction, then the seller gets the rest of the money, right? So it's the same thing. You sell your house on, if you move out of the house, then yes, you have to pay the lender back. So you can sell the home, or you can use other assets to pay back the lender, and then the reverse mortgage lender will release the lien just like any other lender, mortgage lender. So therefore, people need to understand that they're not tied to their house when they do a reverse mortgage, but we do like it when they love their home and they want to stay there, because that would be the ideal borrower, is somebody who loves their house and wants to stay. That's what it's designed for, to help people stay in their house. Because
Right.
another way to think of a reverse mortgage is that it allows you to spend the equity while you're living in the house. So if you're spending the equity while you're retired, that means you're leaving less money for the heirs, perhaps in the future, if you're using the money. I have some people who get their reverse mortgage and don't use it because they just want emergency funds.
Gotcha.
But if they're using it, then they need to realize that there's going to be an impact in the future, either to them if they move out, right? You're going to get less money when you sell. So that's why I always caution people, if you're going to move out in 2 or 3 years, maybe do something else. Or they're going to leave less to their heirs.
Yeah, that's good.
Yeah.
Jason, any extra thoughts there on what happens when people move out or pass on?
No, but just to clarify, and I think you mentioned this, but so an individual who has a second home, maybe it's not a rental property, but just a second home, but it's not their primary residence. You can only do the reverse mortgages for what is your primary residence, or can you do it on a second home?
Oh, you are correct. It's
Okay.
only on your primary. Let's underline that.
Yes.
Very important. Yes.
Gotcha. And then okay, so we kind of touched on earlier different ways of how you can receive the money, right? Through the line of credits and whatnot. I guess it'd be good to move on to, if you guys are okay with it, let's paint a picture of the ideal individual who would benefit from a reverse mortgage, so we can kind of understand who it's not for, right? Is if somebody doesn't need, they have the capital in retirement, they're fully funded, and they might not need to tap into their equity. But who is it best for, I guess, just to paint a stereotypical ideal client?
They're really, the reverse mortgage can be used for so many different reasons that I really can't put it in a box like that.
Mm-hmm.
And even, a lot of people say, oh, I don't want to do a reverse mortgage unless I need it. That's not even the current thinking. I've had people with extremely large estates, do a reverse mortgage, and they're a lot more complex, I guess, in how they do their finances. So they leverage things, money, and move it around in ways that I actually can't really understand, but they found a reverse mortgage useful for their purposes. So that's why it's really hard for me to pin down. I would say like maybe I could do like an average borrower. We can talk in terms of the average borrower instead of ideal. So yeah, the average borrower is looking for a way to increase their cash flow. They're retired. A lot of them are only on Social Security, or maybe Social Security and a little bit of pension. But the reverse mortgage allows them to take monthly payments to supplement their income. And that part of it is not, it's a loan. So it's not taxed within, you don't pay income taxes on loan proceeds. So that's why like financial advisors, like you folks, are looking at it in terms of managing tax brackets, tax liability, things like that. So that's kind of getting a little more complex. But at the base, the most basic, it helps people utilize their equity while they're living by giving them additional cash flow relief so that they can make ends meet. But then, we have others that, again, are you just getting the reverse mortgage and not using it. And remember I told you about the line of credit, how there's something really cool about it. So those people who really don't need the money now, these are people that maybe don't qualify for long-term care insurance, but really would like to stay in their home. They think that maybe in the future, I might need an extra resource of cash. So they're planning ahead, and they look at the reverse mortgage line of credit and they go, wow, what? It's growing at the current interest rate plus 0.5%. And they see, so it's kind of interesting, right? Like, you go to a bank and you get maybe a $200,000 line of credit, like a traditional line of credit. And that's it. That's what it is. It doesn't get bigger. But the HECM line of credit actually grows at the same rate that it would if you borrowed the money. So if you're not using it, it's still going to grow as if, the amount will grow that you can use in the future. So, you know what today's rates are now, right? So if you had a line of credit like 200,000, 300, 400,000, and you're just sitting, you're 62 and you sit on it and you let it grow until you're maybe 70 or 80 years old, it could potentially double during that time. And you can have more funds to be able to pay for long-term care in the home, or maybe, even put a deposit on, say, a care facility, even like Kahala Nui or something, in the future. And then, of course, at that point, if you did use the money for that and you moved out, you have to pay the lender back. But, people are using it as a planning tool. So that's the cool part about the line of credit.
Yeah. And I think just, other things you mentioned, right, was like people that love their home, want to live in their home, all those things are positives, right? So I'm not sure if it's like, maybe who it's not for, maybe not where we're going, but people that are opposite of that, right? People that are not looking for those things, and maybe they're going to sell their home. I'm just curious, right? Obviously, this is maybe off the cuff here, but like, what would it look like? Let's say, you mentioned like passing things on to like heirs and things like that. Like, what if that's like, how can people look at this as reverse mortgage isn't a negative to that? It actually can help with their parents and their caregiving, and they don't lose the home in the end of it. So like maybe talk to that thought process, if that question makes sense. Because I can think of myself, right? Like, hey, like parents, don't do that because we're going to lose the home. And this is, for me and my siblings, right? So I guess, does that make sense? I guess what I'm asking.
It's almost a daily topic. So when I do a consultation, an initial meeting with somebody who's looking at a reverse mortgage, I always ask about, what are your dreams, your hopes, your intention for your home in the future, just to get an idea of what it means to them. Because for some people, it's a family home. It's been it's for generations, right? Been a part of their family, and they don't want to lose it. So I need to know that, so that when I explain how the reverse mortgage works, they can have a understanding that you're using your equity now. And And that means there will be less for your heirs in the future. Or if you live a long time, say you live to 110 years old, or the interest rates go up, there's a possibility you don't leave anything to your heirs. And so the other part of the discussion is this: who owns, who does your house belong to? Who does your equity belong to? So, because they have to get that in their head, straight in their head, right? Is it my equity? Like, it's my house. I paid for it. I made improvements. I invested in it. It's my house and it's for me to use the equity. Or is it, I take care of my kids and I want my kids to stay in Hawaii. So I'm going to do everything I can to preserve that equity for my heirs. Like, I need to know what they're thinking, so that they can know what they're thinking too. A lot of times people feel guilty. My customers will feel guilty. They're seniors, they're struggling, but they're like, oh, I really want to leave the house to the kids. And I think it seems like they feel that they'll be bad parents if they don't leave a legacy of property, I guess, to their kids. So that's why my how they call it a sales cycle, when you go from, the first consultation to your closing or whatever. Mine can be years. Wow. I can be talking to people for years because they have to unravel all of that. Who's the priority? Is it me? And as a homeowner, am I the priority? Am my retirement the priority? Or is it my kids and the inheritance?
Yeah.
Those are really big issues. So once that gets sorted out, my borrowers understand that if they don't financially independent, that they might have to rely on their kids, or their kids might have to help them out. And that may or may not happen, right? And they have to make that choice or take that chance. Are my kids going to be there for me when I need help? And my borrowers, most of them decide, well, I don't want them to help me either. I want to remain independent. So this is the way I'm going to do it. I'm going to use the equity that I built into the home, and then they can have whatever remains, So that's the general attitude for a lot of our borrowers is, I need this. If I'm going to survive retirement, if I'm going to be able to fund it without having to ask my kids for help, then let me do this. And I have life insurance, or I have other things that I can give you. Or sometimes we talk about, I have to remind them too. They feel guilty, right? So I remind them, well, did you send your kids to college? Don't you watch the grandkids, help babysit? All those things are, you poured into your kids. Those things matter, and they're priceless. So sometimes, it just kind of takes a little bit of just digging deeper into the relationships and their role as parents and sorting those things out. Sorry, I don't know if I answered the question the way you wanted me to, but that's kind of what I get into. I'm a specialist. I'm not a loan officer where I just take the application, process it, and then close your loan. This is a dialogue. This is a discussion, and it's important. Let me say this to anybody working with somebody right now or thinking of doing a reverse mortgage: work with a specialist who has years of experience, somebody who actually cares about what happens to you in retirement and isn't so concerned about you moving forward with the loan as they are with you making the right decision.
Absolutely. I think that's great advice for any service or any type of professional type of provider in that respects. Yeah. And to me, all I hear is like there's so much different planning opportunities, right? Like, not one size fits all. There are great options and, things that we can tap into or just, have available, right? So, for us as advisors, like looking at that, and not being so negative or anti these types of things, but really looking at it as like, okay, like how can we serve and just be well educated in those types of things? That's really awesome. And thank you for sharing that. I mean, Jason, I'm not sure if you have any thoughts there before we move into probably, one of our last questions.
No, I love everything we're talking about. And I think it's funny. The default thought process for a lot of people is the house is the house and we're not going to touch it, right? And it's locked in, and we're going to find other ways to make things work. But the reverse mortgage is a great tool, and sometimes it's the right tool for the job, especially if you're short on funds in later years. I love that. And I love what you mentioned, Wendy, about the possibility for some people using it for long-term care planning, because I mean, those costs are just rising, higher and higher. And it is harder and harder to live, especially in a place like Hawaii, for a long period of time in your later years. And this is a great tool in the toolbox, just like our annuities, our life insurance, everything else. And it's not a one size fits all. I'm happy you said that as well, and you just gotta ask yourself those questions, figure out what it is your goals are. Is my goal to leave a huge inheritance? And if it is that going to be in the house, or is it going to be in other assets? Is there other ways of accomplishing that? And really just talking through all of it. And I love the fact that this is just another tool in the retirement planning toolbox for them.
Yeah, this is all the stuff that you guys do, right?
Sure.
All the conversations and unraveling of exactly what the goals are, which is why I love working with professionals that care about their clients in that way. So yeah, thank you.
Awesome. So, I mean, I'm not sure if we can, talk about, there's probably a complex answer in, costs or things like that. But just curious, what would someone expect, right? I mean, everybody knows that it costs money to originate a loan. It takes money to, process these things, and, people have to earn things. But I'm just curious. And if you can't share everything, that's perfectly fine. But what would that process look like? I mean, you're spending years with these people, right? So what would that look like for a traditional reverse mortgage? Like, what can someone expect in a cost associated to that?
Okay, so for costs, there's the thing that, when I think about it, most of my borrowers understand the cost, so they don't really, they're not really surprised by it, which is, I'm surprised now that I think about it, because the costs, if you're comparing it to a traditional mortgage, then the costs are high. Okay, but it doesn't do the same thing as a traditional mortgage. And I think most of the borrowers, by the time I'm done talking to them, they understand that it's a totally different kind of a tool for them to be able to stay in their house and use the equity from their home, And so the largest cost would be, right now, it's a 2% FHA upfront. So it's a one-time mortgage insurance premium. Because remember, I said this is a government insured loan. So the borrower then has to pay FHA mortgage insurance. And I think the reason why they're not surprised, like say you have $1 million, like $1 million home, 2% of $1 million is quite a bit, right?
Yeah.
So they don't really balk at that. I mean, it's just, and I think it's because when we explain what it's for, they understand it. So let me just explain what it's for. So FHA mortgage insurance, it is there just in case the loan balance exceeds the value of the home at the time of repayment, which could happen if the borrower say they're 62 and they use up all of the money and all of the reverse mortgage funds, and then they live till they're over 100 years old, right? The loan balance grows if they're not making payments back. And it's optional, by the way, that's why I said it. It's optional to make payments back. But if they don't, the balance at the end, say they owe $1 million and the house is only market value is 900,000. Oh no, what happens? So the FHA mortgage insurance fund is what's going to cover the shortfall at the time of payment, so that the heirs don't have to worry about coming out of pocket with that money, right? So the insurance fund will cover them. And it's also good to know that, how mortgage companies come and go. I'm at one that's going to be around forever, by the way. But there are mortgage companies, that merge with other companies. It's just, they're here one day and gone the next. because of a difficult, when the times are difficult in the economy. So the FHA, the fact that the FHA insures the loan means that the borrower, even if their lender goes under, let's say, their loan will continue without any interruption because the government will pick up the loan, will continue processing the loan and give the borrower full access to their funds. So that's like the two main important functions of the FHA mortgage insurance. So when you talk about 2% of the appraised values, and it's capped, by the way, it's capped. The insurance has a cap on it, and without getting too technical, just know that. But they understand it. Borrowers understand the importance of it, and that's not the only, by the way the premiums are collected on FHA mortgage insurance. It's collected a second way, and that's like right now it's 0.5% on whatever the loan balance is. So 0.5% on the funds that were used. So that's the biggest cost. And then you also have another large cost, which sometimes, depending on the market situation, you can, it's origination fee. And the maximum origination fee now is $6,000. So that may not be negotiable. And then you have the other costs that are, people are familiar with, the appraisal fee, title insurance, recording charges, credit report, other things like that. But those two that I mentioned are probably the biggest fees. So, but and again, we explain everything. So if the borrower doesn't like it, they don't have to do it, and maybe that's why I don't see it so much. It's the ones that move forward are fine. They understand what the purpose of it is, and it's to help them, not to hurt them.
That's good.
Yeah. And then you asked about process. So the consultation portion of the process, again, could last years. Like the longest, I think, was 6 years.
Wow.
I first met the borrower, and then I kept meeting with the borrower, and then 6 years later, they're okay, we're ready. So that part is long. The consultation process is long. And then the other part of the process where you go application to closing, anywhere, I think right now between 30 to 60 days, depending on the complexity of the loan. And right now we're getting a lot more complex loans. So I'd like to say 30, but I'm giving some room there in case there's tight trust issues, or not trust issues, but the legal trust issues and things like that. Yeah.
Yeah, for sure. That makes a lot of sense. And, I think that was a great explanation. And again, when you're working with someone like, for our listeners, when you're working with someone like a specialist like Wendy, obviously having an understanding of getting those things spelt out for you is something that they do. So, and at the end of the day, when you're someone who needs access to funds like this, the cost is kind of the cost to be able to maintain a lifestyle, right? And that's totally understandable. So, Jason, any closing thoughts here? Any last things on your mind?
No, this was great. Very informative. Wendy, thank you so much for taking the time and joining us on the show here. We appreciate it.
Yeah, thank you so much. We can have a part 2. There's so much more,
Yeah, I was thinking we probably should, and we'll see if we'll offer it up to our listeners if there's any questions. Obviously, not super specific, but any questions they might have for follow up, maybe we'll bring you back and we'll just answer some of those.
Awesome, thank you.
Awesome. Absolutely. So with that, thank you so much for joining us on this episode. We hope that you guys found value, and thank you again, Wendy Oshiro with Mutual of Omaha, reverse mortgage specialist. Thank you so much for your time. And we look forward to the next conversation. Have a great day.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting their financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita, Paul McWilliams, and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial or Inspire Advisors. For Jason Katita, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration. And for Paul McWilliams, investment advisory services are offered through Inspire Advisors LLC, a registered investment advisor with the SEC.